Okay guys, so we're getting into the real meat and potatoes now of system development. And the systems I deploy vary quite a bit on how active they are. Some require a small amount of attention each month, whereas others require more frequent and daily management. But something that's very important and something we've mentioned in previous videos is that all of my systems are intentionally simple and robust. There aren't many moving parts. We're not trying to build highly complex machines here. Remember, we're working on daily timeframes. We're capturing moves that unfold over days or weeks, even months, not milliseconds. This is very different from the kind of high frequency strategies that hedge funds may deploy. The ones that are trying to arbitrage tiny price differences at extremely high speeds. That's not what we're doing here. Instead, we're focusing on simple behavioral tendencies in markets. Things like momentum and mean reversion, patterns that have been observed in financial data for decades, possibly even centuries. Remember guys, I'm doing my best here to try and explain the ideas as clearly as possible in these videos, but don't worry if everything doesn't click immediately. As we've discussed previously, systematic investing is a long-term process. But if you want to follow along more closely, you can head over to my website where I show you the systems running live and where you can ask me any questions you like in further detail or seek clarification. Another important point is that these strategies can be used individually or together. So some people prefer slower systems and might cherry pick, whereas other people prefer more active systems and might select the ones that are slightly quicker. But personally, I combine several approaches because in my experience, the single most powerful risk management technique in investing is diversification. That means I want to spread my capital across different strategies, different speeds, different markets, and different behaviors. Remember, the goal is not just to outperform the market. The goal is to outperform the benchmark on a risk-adjusted basis, and that means I want a little bit excess return, I want lower volatility, and I want smaller drawdowns. But what I absolutely want to avoid is seeing my account drop more than 50%, which is exactly what happened to many investors during the 2008 financial crisis. So with that framework in mind, let's look at the next strategy. This one is the US Mean Reversion system. So before we look at the rules, let's dig in and talk about the actual basic premise. Mean reversion is built on a simple observation. Markets tend to overreact in the short term. When a stock falls sharply in a strong market, that move is often exaggerated. Investors panic, short-term traders exit, liquidity temporarily disappears, and prices overshoot. What often happens next is a snapback move, not always, but often enough to build a statistical edge. So mean reversion strategies attempt to buy short-term weakness within longer-term uptrends. The last part is important. We're not trying to catch falling knives in collapsing markets. We're looking for temporary weakness in otherwise healthy stocks. So the first thing the strategy does is determine whether the overall market environment is healthy. So for this, we use the Russell 1000 index as a broad proxy for the US market. We measure whether the index has been rising over the last few days. If the broad market is positive, we assume the environment is supportive. If it isn't, we become more selective about what types of weakness we want to buy. This step helps prevent the system from aggressively buying stocks during broad market panic, because during true market crashes, mean reversion can fail temporarily. So this filter helps keep the system trading within favorable environments. So next, we restrict the universe of stocks. We only trade companies that meet several criteria. First, as you've heard in previous videos, the stock must be trading above its 200-day moving average. This ensures we're only buying stocks that are in long-term uptrends, so we're going with the trend. Second, the stock must be sufficiently liquid. That means it has a high daily trading volume. This prevents the system from trading small, illiquid companies where prices can move erratically. And third, we also require a minimum level of trend strength, measured using a technical indicator called ADX. Without getting too technical, the ADX simply tells us whether the trend is strong enough to matter. So the system is essentially saying, only trade liquid stocks that are trending upwards strongly. So once we've identified strong stocks, the strategy waits for temporary weakness. Specifically, it looks for days where the stocks sell off and closes nearer the bottom of its daily range. That tells us the sellers were dominant during that day, but instead of buying immediately at the close, the strategy actually places a limit order slightly below the previous day's low. This entry is based on something called the ATR, which measures typical daily volatility. In simple terms, the system waits for a small additional drop before entering. This helps capture moments where the market temporarily pushes prices too far. So when many stocks meet the entry criteria, we need a way to choose which ones to trade. The system ranks stocks based on how weak they've recently been, but the look-back period changes depending on market conditions. If the market's been strong recently, the strategy focuses on very short-term weakness. If the market has been weaker, the strategy looks at slightly longer-term weakness. This adaptive ranking helps the strategy respond to changing market environments. So the system can hold up to 20 positions at once. Capital is spread equally across those positions. The strategy also uses moderate leverage, around 2 times capital. Leverage obviously increases both risk and return potential, so this needs to be handled carefully, and we've got a separate video where we discuss that in more depth. But the key point here is diversification. Rather than betting heavily on one idea, the system spreads risk across many small positions. So there are 2 main ways trades exit. The first, if the stock rebounds and moves above the entry price, the system simply takes the profit. Mean reversion moves tend to happen quickly, so the system doesn't try and hold trades over long periods. Second, there is a dynamic exit based on a shorter moving average around 40 days. If the price closes below that level, the system exits. This acts as a protective mechanism in case the stock continues falling. So mean reversion strategies behave very differently from momentum, as we discussed in previous videos. Momentum tends to perform best during strong trending environments, whereas mean reversion tends to perform best during choppy and sideways markets. And because of this, the 2 strategies can complement each other very well. And when combined in a portfolio, they often produce smoother overall returns. And that is exactly why I use multiple systems. Different market behaviors require different approaches. So that's the core structure of the US mean reversion system. It's built around a simple idea: buy short-term weakness inside long, strong upward trends. The system rules are simple, the logic is clear, and when applied consistently across a diversified portfolio of stocks, it can create a repeatable edge. And remember, the strategy is just one piece of a broader framework. No single system should ever carry all of the weight. The real strength comes from combining multiple uncorrelated strategies across markets and behaviors. That's where diversification really begins to work in your favor. So in the next videos, we'll continue exploring other strategies and how they fit together into a complete systematic portfolio. Thanks for watching, and I'll see you on the next one.